So watch the stock market if you're in gold, because the stock market gets more evidence of wobbliness. Watch gold, because it's going to say, okay, we're inverse, we're now going back up. And I think the miners will too.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 19th through February 26th, 2024, while supplies last. First, we feature 2023 1-ounce silver Britannia at $3.15 over spot with a minimum order of 50. We also have 1-ounce Gold Krugerrand at only $59 over spot. And finally, we're offering 1-ounce Platinum Valcambi Bars at just $69 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back, Elijah.
Well, it's great to have you today. I did want to discuss the precious metal markets and also the stock market, because your recent analysis has been signaling that both of them are in a sense linked. There's a lot of funds that you believe are going to be moving out of the stock market and into the precious metals, and they're just kind of waiting for the stock market to decline right now. Now, one thing that it seems like is happening right now is, based on your momentum analysis, there are actually concerning developments in the stock market, if we want to start off with that.
Well, everybody knows that the market is narrow, stock market. It's probably never had such narrow leadership in its history in terms of achieving a bull market peak. What percent of the stocks were leading it, and we're down to, you can name them on one hand. Okay, and that's even narrowing, by the way. Apple and Microsoft are no longer playing the game like NVIDIA is. So NVIDIA is all that matters. It's all you need to know. Go long and be happy. Okay. Well, anyway, there's a lot of asset managers in the stock arena who have to be long stocks because they're going up. If you're not long stocks and part of the party, then you're underperforming your competitors. And so people will move money to the fund that's making more money away from the fund that's making less. So even if they don't like the stock market, fund managers have to be there. But a lot of them, and I don't know how many, but easily 50% of them are a bit nervous. They've been around long enough to know this stinks. It's too narrow. It's too bubbly. The kids in the street are screaming about it. Not the old guys, but the kids in the street are screaming about how the stock market's doing. So they know that they're probably in a dangerous position, and so they're probably ready to push the button and reallocate some assets. Especially out of tech, let's say, like Druckenmiller did a few weeks ago. He sold some big tech and moved into gold miners, Barrick and Newmont. Well, it turns out just the other day, another guy named Paul Singer from Elliott Management apparently has made the move as well. I don't know to what percent, but apparently enough to be noticeable in the press, into gold miners. And, people forget about the notion that I guess your granddad and your father knew about, and so many in your generation don't, that, buy cheap, don't buy high. Buy cheap, buy value, buy something that's not going to go to zero, that's as close to zero as it's going to get. That's the best place to be. And, you might be 6 months early or a year early or whatever. But now the miners, after the pullback from the 2020 rally high, where they surged much more than gold on a percent basis, they've come all the way back down and erased a good chunk of that move, not going back to the bear lows in 2015. At that time, for instance, GDX was $14. It's trading right now around 26. So it's still, a little, almost double where it was. But it's had a big pullback, 20 some odd point pullback, a huge percent over the last 3 years. So a lot of people are just pulling their hair out. This is garbage. It's no good. Well, some sectors, some stocks can go out of business because, well, aside from business malfunctions, but the nature of what they fabricate or what they deal in. You can maybe be a chip maker that the world no longer needs your kind of chips. You're gone, et cetera. But you're not going to, gold miners unless they're the speculative. There's speculative ones always, and there's some that go out of business, just like in any industry. But basically, it's ground to theoretical zero right now. And I think some smart money is seeing that and starting to make the move. And not concerned they're going to make money this month, but probably they got a major low in a major market that's the most undervalued it's ever been relative to gold, relative to the S&P, relative to anything. And it isn't going to zero. And they're already taking the step. Now, there's other asset managers who haven't done it, but they've been listening. Druckenmiller did this. I wonder why he did that. Paul Singer did this. Well, why did he do that? And so they're thinking about it. It's got them thinking and doing some homework. And so what we argue, and we've argued since mid-December, that's when the Fed minutes came out. And the Fed basically said, we'll cut rates maybe next year, but we're not going to raise rates anymore. Okay, now I don't think that's changed really. There are few commentators have said maybe they'll raise rates. I don't think that's going to happen. And I don't think most people think it will. But the issue is, when will they cut rates? Well, maybe that doesn't matter. The point is, maybe it's already the Fed party is priced in. And if you look at an S&P chart starting in mid-December to the present, it's this. Look at a gold chart since then, it's that. It's down and then sideways. Silver's been down and then more down, not to lower lows, but more down than gold. Gold's been sideways. And the miners have been punished. And another market that's also moving with gold is T-bonds, price-wise. In other words, as gold has pulled back, this is true for the last year and a half, actually. The bond market's been fairly well synced with gold, not with the stock market anymore. And I'm suspecting that you get enough wobble in the stock market, especially due to this NVIDIA bubble, possibly being pierced at some point, then some of this money is going to flow somewhere. And I think a lot of people are going to move into the gold miners because of the reasons I explained. And it's such a tiny little sector that we've described it'd be like a wet bar of soap being grabbed. And I think you got to be aware of that. So if you're thinking in terms of an investor, not a trader, you got to be looking at the gold miners. Gold's behaving quite well. Miners aren't. Is that going to continue forever? No. So think about it. A couple big guys have, and a lot more of them will once the stock market starts to wobble. Do we think we're near a wobble point? Yes. If we see that today's high holds where it was in the S&P and the NASDAQ, we're near the end of the month now. There's 4 more days left before the month ends. And if we don't extend monthly momentum beyond where it's already been with today's high, which is the high of the month in price, it did not take out the momentum high of last month. So when you look at a monthly momentum chart of the S&P or the NASDAQ 100, instead of seeing strong December, strong January, strong February, you see a strong December, a flat January, and a slightly declining February. So momentum is actually paused and built like a range at a high level. So it's overbought and it's stalled. All it's going to take next month, meaning starting Friday next week, is to downtick 1% or so in these indexes. And I'm going to start snapping the momentum lows we've seen in February and January and December. It won't take much. So what we need to see right now to get that rolling is, I think, simply a pause and perhaps a minor pullback between now and the end of the month. At that point, we say, get ready. The stock market's probably ready to downturn. And I think gold won't wait for that. See what's happening today, for example. Gold's about $20 off its low. The stock market only began to wobble a bit. I think it's inverse. So watch the stock market if you're in gold, because the stock market gets more evidence of wobbliness. Watch gold, because it's going to say, okay, we're inverse. We're now going back up. And I think the miners will too.
So this time you don't expect a pullback in gold along with the stock market? No.
That's a very rare event. People are burnt in their memory is 1 month in the year of 2008 when we had at the late in the bear market in the stock market. It had peaked in October of 2007. In October of 2008, already substantially off the highs, you had a month that basically you could call a crash, October. It hastened you toward what ultimately would be the low in March of 2009. During that month, gold said, oh, I'll go down with the stock market. But if you look at the context of gold in the years prior to that, and then the years after that event, it was opposite the stock market. So people are just fixated on that one event. It's burned in their memory, and they think, oh, stock market goes down, gold will. No. Historically, it's mainly the opposite. Look at the late 70s. We had one of the biggest bull markets in gold. 76, you made a low at 103, mid-1976. You were at 850 by January of 1980. Much of that occurring in the last year. Well, what were stocks doing? They were a wasteland. The stock market, you made no money for a decade in the stock market. And yet commodities and gold soared. So don't make that false linkage.
That's a very good point. I think people are maybe looking too much at recent history rather than looking at more of what happened in the 70s there. Now, when it comes to, I guess, more of, I wanted to kind of hone in on this one aspect you said about the stock market here, and you did mention it in your latest newsletter here. I'll put it on the screen here, just kind of pointing out how the momentum in the stock market has really slowed down. And that's not something that the mainstream is really paying attention to, because they're just looking at the daily price just continuing to go higher and higher.
Yeah, especially things like, NVIDIA, okay, or advanced micro devices, or et cetera. That's what they're looking at. In fact, if you look at most sectors of the market, they're not near the 2022 highs. Most sectors within the market are not. They're trying to, but they're not close. So the S&P is extremely narrow. So is the NASDAQ 100, especially with front-end loaded symbols, like a half a dozen of them. And even those symbols, if you look at Apple and Microsoft has wobbled real hard over the last few weeks, and Apple can't seem to get off the floor at 180. And we think 180 is a kill number if you close a week there. So two of the big leader symbols that used to be leaders are suddenly now anemic as heck. And we're now getting down to, one or two stocks. And people, for some reason, are blind to it. So when that comes undone, and we've already seen evidence of it in the momentum, where prices, momentum was with price in October, November, December of last year, during the first part of the surge. But especially when we got into January, late December, early January, momentum started to fade in terms of it didn't go up anymore. Price continued up. Momentum said, And there's structure below on momentum. If you see a price chart of the S&P now and try to draw lines under it, it's like upward curve. You can hardly draw a trend line with at least 3 points establishing the line. You can't do it. You look at the momentum chart, you see a floor from, I won't use the word. You've got a floor underneath you that's so clear that if you were looking at momentum right now, you say, oh, goodness gracious. That's terrible looking. So, and I think that floor will be exploited as a breakout point, and probably early next month.
Now, you're saying that will be a breakout point early next month. When do you expect this move then in precious metals? And what about the move for gold versus silver when we see this?
I think the silver-gold spread will shift. In fact, you've seen that anytime you see a surge that lasts, let's say, a month or so in the monetary metals, generally silver will beat gold. And similarly, when gold pauses or pulls back a little bit, silver will beat gold on the downside. So it's a wild child. And the same is true with the gold miners. There have been points in time, especially that spring to summer 2020, when gold went up, 40%, and they went up triple, So they're slingshot type markets, silver and the miners especially now. And I think the biggest slingshot I've ever seen, possibly in my entire career, which goes back to the mid 70s, is what the miners are set up for right now. And I think there's some big guys out there who may not be looking at charts like I am, momentum charts especially, but realize just on a fundamental basis that this is a place to be. Nobody wants it. I'll take it. While the stock market caves, if you think gold stocks go with the S&P, look at the chart the last 3 months. Total opposites, okay? So expect that to continue. Stock market goes down, those gold miners are going up because they're going to be grabbed by a lot of asset managers.
Now, what then has fundamentally shifted? What has made it that there's no really correlation anymore between the stock market and gold?
Well, it's not been one really for a long time. You could go back and find a few periods over the last 50 years where stock market was in a bull and so was gold, but generally gold led. Well, for example, gold was a bull from 2000 to 2008, and then had that nasty October, part of September and October. And then by March of the next year, while the stock market was making a new low again, March of 2009, below the October crash low of 2008, gold was back at its highs. It had been around $1,000. And then gold proceeded to double over the next, several years, 2009, 10, 11. So the next several years, it doubled from 1,000 to almost 2,000. At a point in there, after that March low in 2009, the stock market did, in fact, turn back up. And you could almost argue, well, the stock market's following gold. So it wasn't the other way around. Remember, gold's been around for thousands of years. And no matter what some people might like to say, it's not lost its intrinsic value as money. It's still regarded. You can jump from a plane and parachute in almost any country in the world and land, and I don't care if it's a civilized world or what you might call primitive. They know what gold is. Okay, it's universal, and a lot of people are becoming aware of that again. Not so much in the U.S. government, but in a lot of other governments, for example, are buying the heck out of gold. We know that. And there's no doubt reasons for that. But anyway, no, the linkage is pathetic. It's coincident a few times in history, enough to burn it in people's memory. They're linked. No, they're not.
Now, one index that you've also been looking at recently that has shown a bit of correlation with gold is the US dollar index. What has that been showing recently, and is it bullish for gold?
Well, remember, the dollar index was at 115 back in late 2022. That was when the bond market made a low. I mean, yields were high, okay, and that helped promote the dollar, okay, relative to other currencies. So the dollar was at 115 dollar index. Now, remember, the dollar index is about 70% comprised of the euro and the yen, okay? So it's really almost an inverse of the euro, which I think is like 56% or something of the dollar index. But then you collapse from the 2015 high in the dollar all the way down around the 100 level. I think 101 had been the low back then in early 2023. Well, at that same time, bonds rallied, so did gold. Okay. Now, bonds went down and made a new low in price October of this past year. So a year after that, October 22, new low. Now, if the dollar had fully reflected the rise in rates here, when bonds went down and took out the price low in 2023 of the 2022 low, then dollar index should have been back at 115, right? No. The highest it ever saw in that rally last year was 107. Then it puked back down again toward 100 again. Right now we had a rally up to 104. But right now, if we close the week out where we are now, below 104 on the dollar index, we're going to break its weekly momentum. Now, that's not a great big giant metric, but it's enough. We've been living above it for 9 or 10 weeks, similar to the stock market, which is very interesting. In other words, the dollar index has been more or less behaving like the stock market, living above certain moving averages, a happy bull, so to speak, but anemic for the dollar. And right now, this week, if you close where you are now, you're going to break a structure on momentum. You can't see it on price that says, uh-oh, we're going to start back down again. Well, there's some mega numbers on the dollar, annual momentum breakage numbers that we can define using a 10-year moving average and a 3-year moving average. You better not get back down much under 100 ever again, because you do, the floor is going to come out in a big way. And I suspect that's what maybe we're starting here, is this rollover we're seeing now from the 104. We're now got it way up in the 104s rather recently. Now we're under 104. It's a start of a rollover again, which might also be coincident with a rollover in the stock market because it's been behaving in sync. So that could help gold. But I have to caution again that, yes, sometimes there's some intermediate times where you can look at gold and look at the dollar and see their inverse. But put this in your mind. If you waited on the dollar index to tell you to buy gold, okay, here's what you've got since December of 2015. Gold was at 1,050, okay, bare low. December 2015, the dollar index was around 98, okay? Since then, the dollar index right now, how many years later, okay, 2015, 2024, it's 103 something. So 3, 4, 5, it's up 5 or so percent. And it's been either side of that 98 price level, by the way, in the years since. So it's been up and down. But right now, we're only about 5% higher than we were at the end of 2015 when gold made its low. Gold is double where it was at the 2015 low. So using that correlation between the dollar and gold is not a great idea. I think it will help gold when the dollar does break, especially if it goes down another, let's say, 4 or 5%. It's really going to fall apart. At that point, it'll no doubt help gold. But it's not an essential. Gold's demonstrated that.
Now, what you're saying when we look back at the beginning of this interview about even, a major money manager moving into the gold sector, and that there needs to be a movement out of stocks before we see a big move in precious metals. It reminds me of an interview we did with Andy Scheckman. He was mentioning that there are a lot of billionaire CEOs right now that were dumping stocks. And this was back, I think, about a month ago or so. But I'm just thinking also before the 2022, correction in the stock market, we saw a similar thing where a lot of billionaire CEOs were selling a lot of positions. What other signs are you seeing that the big money right now is positioning for this move?
Well, you talk about the insiders who sort of intimately know their own companies, and they know that while everybody's claiming, oh, this is we didn't even have a soft landing. It's so great, and they're looking at the world from the point of view of their own company, whether they're in the tech arena or they make metal fabrication or whatever, they're looking at reality through their lens of, what's the demand for their commodity, their product they produce or service. Is it really as strong as the stock market would imply, or is it more anemic? Is it more on the edge than the stock market would suggest? They see a reality that a lot of stock investors don't see. And a lot of these guys aren't economists. They're not out there looking at the macro economy. They're looking at the real world from their perspective. And so when they see their stock, perhaps what they consider to be a bit overpriced, they don't want to go down the loo if it goes down. They want to make sure they got enough money on the side where, their home's paid for, they can give money to their kids, that they're okay no matter what happens to their stock. And therefore that crosses their mind. I need to liquidate some of this. Jeff Bezos dumped a ton of it, Amazon, and he's not alone. And I don't know how you read that. It's a wet noodle indicator, because if you go back, this really got higher than what you said in terms of the number of exits that were signaled by these company folks that. It was like over the last month, it got more intense even. I think it's a record. My son Brett told me he thinks it's a record level of evacuation from, companies by their owners. So, yeah, it says something, but, it's a wet noodle indicator because over those last month or so, stock market's still gone up. So it's not something it's not a pinpointer, but I think it's a good background indicator. At MSA, we don't look at that. I mean, we notice it. We try to put blindfolds on because we call that a wet noodle. We want something that when it breaks, probably, you're going to get a consequence pretty soon, if not immediately. And usually that's a momentum structure, not a price chart technical, but a momentum's technical. And therefore, quite often we're ahead of the price chart turns in terms of anticipating the turn, whether it's a bottom or a top. And right now, I'm seeing enough evidence to say, if you're long stocks, you better start getting antsy here. You better pay close attention because it's not what it appears like. And we'll see. But I think over the next week or so, we're going to get some evidence that will validate what I'm saying. And if it does, of course, it'll be in our reports. We'll be pounding the table.
Definitely. And people can go to olivermsa.com to sign up for those. Did you want to share with our viewers kind of the general price points you're looking at for the S&P 500 and also the precious metal markets for this shift to occur?
Well, especially the NASDAQ is, it got up to 18,000 and a bit above here just today and yesterday, taking out the prior high by just a bit. But if you go back and look at 2022, where we were, on the NASDAQ and look at the S&P where it was in 2022, its peak. Actually, NASDAQ peaked in November 2021. Its high trade was 16,800. Okay, we're now just below 18,000, I think. So it's not a huge percent gain versus that. And it's only been for the last few months we poked out above that prior high. So it's not like we're 30% beyond the 2022 high. We're in single-digit percents above the 2022 high, enough to get people's attention. But it's not from an investment grade point of view. If you got out when we said to, with January of 2022 and February of 2022, depending on the index, you're missing about 5-6% of the market action over the last 2.5 years. So, you're not missing a lot. And most indexes aren't even back to the 2022 highs, most sectors. And you can't drop, I'll just ballpark it, a percent or two. From where we are right now, you don't want to be trading there early March. It's Friday next week. So we think there's vulnerability, and the main issue right now is what happens over the next handful of days and as we get into next month. Now, I'm not expecting a crash event, by the way. So if we start to break monthly momentum down, and I told you there was like a floor under it. You can't see it on price, but this is like a trampoline it's been using for 3 months now, almost exact same level on the oscillator. So while prices made higher lows, momentum keeps coming to the same level. It's stopping. That structure is not going to hold again. And it doesn't take but about a 1 or 2% drop from where we are now during next month to blow that structure out. That could cause an intermediate decline that gets people's attention. But if there's going to be a real event structure broken where you get some drama, like a 30% drop rapidly, crash type event, that's going to be a second quarter event. If we position properly between now and then, and right now the key issue is let's stumble the market just a bit, pull it back not only a percent or two to break monthly, but get it down near the levels that when we open the next quarter, which is 5 weeks away, the quarterly momentum gets into gear and it blows structures that are very credible and already established to break it. There was a floor on the quarterly. But when you break that, that's when the noise really starts. So right now, all we're looking for is the initial wobble. And I think gold will see that clearly. And as far as a number for gold, we know it got to 2150 back in December. Didn't stay there, but for a few hours. Buy stops being triggered, okay? And then there was a vacuum of buying underneath because you triggered all the buy stops. And since then, you've consolidated mostly above 2000. We had a brief dip in the 1980s in late December. And again, this past month, we dipped down to 1990 something. But basically, it's in the 2000s. If you get back over 2100 again, not back to the highs at 2150, just get back over 2100, we've got some metrics that say lid's coming off. And I don't think gold's going to wait for a whole lot of evidence from the stock market to say, okay, game on. It's going to look for the initial evidence because gold is an anticipatory market. It doesn't normally make its moves based on a hard piece of data, for example. You might see an hourly or daily action based on disappointment or happiness to do a data point. But the big trend structures in gold tend to break without any headlines in anticipation of likely headlines to come. Gold's a smart market. And I would say right now, you get back over 2100 gold, you're gone. Silver back over 2350 again is going to look good. Right now, we're just below 23. There's some big triggers on silver as well that say launch time. And by launch time, I mean where you go up in geometric fashion, like we did in the spring and summer of 2020. Silver went from under $20 to 30 in about 6 months. So percent-wise, I think the real liftoff point for silver is just above 25. And we get very specific in our reports. We update the numbers and if they change. But both those metals are poised for a shift out of incremental bull trend into something that chaos theory people would enjoy. Rapid ascent. Break all the models of how you've behaved for the last few years and start to go vertical. And I think that probably will be partly an effect of asset managers saying, I knew this thing would break. I'm getting out of the stock market to some extent, and I'm moving that money somewhere else. And one of the good areas to me looks like gold because it's behaving well and the miners are undervalued. And I think that's where you'll get the goose in the monetary metals. It's just the anticipation of the stock market wobbling.
All right. Well, Michael, we really appreciate your time today. It'll be interesting to continue to track this with you as always. If our viewers are interested in learning more, they can go to olivermsa.com. Can you share with the viewers what they'll find there?
Yeah, we have an all asset category subscription, which I really suggest. It's not because we charge more for it, but it covers the 4 big asset categories: debt markets, foreign exchange, stock markets, not just U.S., and commodities with an emphasis on the monetary metals. The reason I say it's important to look at the 4 asset categories, as I just explained, what happens to the stock market now is very important to gold and vice versa. So, if you're not in the stock market, you should be looking at it anyway, because as it wobbles, gold's going to take the cue that, okay, this asset class shift is underway again. And we know what the Fed's going to do. Gold knows what the Fed's going to do, and the ECB and the BOJ and all the other major central banks. You start to wobble their stock markets, break their bubbles, and start to get data points that follow that event. They've got the excuse to go back the other way. And I know they're waiting for it. probably eagerly hoping for it. Actually, you listen to Powell, he kind of thinks that's good. So looking at all four asset categories is important because they impact each other.
Definitely. Any last thoughts before we let you go, Michael?
No, watch the stock market, especially over the next week or so as we get into next month. Because like I said, you get 1% or 2% below where we are right now, you won't see it on the price chart. But momentum says helmet time.
Fantastic. Thank you so much, Michael, and God bless.
Thank you, Elijah.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 19th through February 26th, 2024, while supplies last. First, we feature 2023 1-ounce silver Britannia at $3.15 over spot with a minimum order of 50. We also have 1-ounce Gold Krugerrand at only $59 over spot. And finally, we're offering 1-ounce Platinum Valcambi Bars at just $69 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.